Thank you very much, Doreen, for setting the pace for our interactive segment once again. We're now focusing on the ripple effect of COVID-19 on the real estate sector. With the stay-home directive that was initiated in March when Kenya confirmed its first case of COVID-19, we saw firms, organizations, both at the public and private sector, embrace this and latched on the issue of technology. How then will this change the real estate sector? Will firms now redefine their spaces? And what will this mean for the real estate sector? Some of the key issues we're going to be discussing this morning. Taking us through this conversation is a research analyst from Cytonn Real Estate, that is Wacu Mbugua. Good morning and thank you for your time.
Morning, thank you for having me.
Now, before we even talk about, how we are redefining, or rather how the real estate is redefining itself, from where you sit, how has COVID-19, impacted on the real estate?
As you have mentioned, COVID-19 has had a rather huge impact on the general economy, and real estate has not been left behind. I believe actually real estate is more of a reflection of how the economy is doing. So right now it's not doing very well, and real estate has been affected as such. So the immediate impact that we've seen COVID-19 having on real estate is things like disruptions of supply chains, that is construction materials for developers, definitely a downward pressure on revenues. Right now with everyone coping with financial constraints, people have lost jobs or had their salaries reduced by probably half. So everyone is having sort of financial constraints. So that has resulted to downward pressure on investor revenues and developer revenues as well. But I would say that real estate has been rather resilient compared to other asset classes like the stock market. So it has remained resilient. In the couple of months that COVID-19 has been in Kenya, the impact has not been that much or that high, but there is definitely an impact, and some sectors within real estate has been more impacted compared to others. Case in point, retail sector, hospitality, they've been the most that have been adversely impacted, while sectors such as residential continue to be resilient. Yeah.
So let's look at the retail sector.
Yeah.
We've seen, firms now reorganizing themselves. They want to go for smaller office spaces because they have realized that their workforce can actually work from home.
Yeah.
And do you think that this is going to, go for the long haul, that you're going to see a change in as far as retail spaces, or rather real estate is concerned?
Yeah, I believe even after the COVID-19 pandemic is over, business is not going to go back as usual. So right now, firms are realizing that our workforce can actually work remotely, so we don't need as much office space. But I believe that the trend will actually affect all sectors alike. So while we see that maybe working remotely is going to be a trend going forward, so now that trend is going to impact residential sector in that now developers will have to redesign the homes and the units, because right now, as we've seen, people are realizing that their homes are not actually enough to cater for families and at the same time have your office space at home. So yeah, I definitely believe the trend will continue even after the COVID-19 is over.
So then, what does this mean? Are we likely going to have a glut in office space, and which areas are likely to be affected? We have statistics indicate that most workspaces, 85% of workspaces, are within the CBD.
Yeah.
So with these statistics and these new dynamics coming into place, then with this glut, which areas do you think are going to be most affected?
Actually, the office sector has had a glut over the past 2 years. As at 2019, the glut stood at 5.6 million square feet, and that's a huge glut. The good thing is that it's not in all nodes. So there are areas that are definitely having an oversupply. Supply is way more than the demand that is there. Places like Upper Hill, where there is supply supply has been growing consistently over the past couple of years. Areas like Westlands, Kilimani. So these places where you see a lot of office buildings coming up, definitely that they are the ones that are supporting the GLAD. But you do see some areas which do experience high demand, yet they do not have as much office space. Areas like Karen, areas like Gigiri, and they've been performing quite well for the past 2 years. Actually, Gigiri and Karen have been consistently leading in terms of rental yields in the office sector. So we believe there's, while some sectors continue to show GLAD, there are going to be some nodes that are actually still pockets of value for investors. Yeah.
So if you were investing in, retail real estate, you'd be focusing on either Karen, Gigiri.
Retail is a whole other sector, and so retail sector, we're talking about the malls and all that. So the retail sector has also been experiencing some GLAD. As of 2019, it was about 2 million. And it's still the same case as the office sector. Most nodes, especially in Nairobi County, we're seeing malls left, right, and center. There's definitely the aspect of huge competition among retailers, because like malls are very the distance between malls is quite small, so there's that competition between retailers. So in the retail sector, what we see is that there is demand in areas outside Nairobi County. So let's say areas like Kiambu, Machakos, areas like Mombasa, Kisumu, those areas outside Nairobi where the GDP per capita is quite high, yet the mall supply is not as high. Nairobi is where actually there's a lot of competition. That's where the malls are concentrated, and we've been actually seeing the result of that is that retailers have been closing shops. ShopRite is the most recent notable retailer that is to close the shop, and they cited decline in footfall, competition. Where they were located, there was a whole other retailer, and just a few kilometers away there's a whole other bigger retailer. So there's actually a lot of competition in Nairobi, but it's not the same case in other counties.
But you see, from a consumer point of view, don't you think then good competition, with the competition, the consumer gets choice?
So that's actually a good thing. With the competition, definitely the consumer has the higher bargaining power. So it's a good thing for consumers, but then for retail investors, it's not such a good thing.
Now, this issue, you've said retail, we've already talked about office space. Now let's look at residential. Right now we are seeing what we are experiencing, rural-urban migration that has been brought forth by COVID-19. Do you think this is one way or another going to also influence, the issues of residential sector?
So the residential sector, as I said, has been quite resilient because, even with COVID-19, people have to live somewhere. But even before COVID-19, we were seeing some sectors overheating, so there was a bit of a supply-demand mismatch, especially in upper market areas. So currently what we're seeing is those upper market areas are experiencing a price correction. So if the prices were way above market average or what people could afford, now they're coming down because developers and investors are ready, or they are desperate to get rid of stock that has been in the market for a long time. However, what we do expect with COVID-19 is that there's going to be a way bigger demand for affordable housing. Already, even before COVID-19, we're already talking about affordable housing and the need for low-cost homes. So right now, with people having income challenges, we definitely do expect that the demand within the residential sector is going now to be in the lower-middle market. There's the aspect of where people now will want to live, especially after seeing the pandemic and what impact it can have on your life. So we do expect people now to move towards areas that are sparsely populated, I would say, because especially within suburbs, the population is quite dense. So we expect now demand to shift away from Nairobi in areas that are cheap or affordable, and those that are sparsely populated.
How about we unpack that? The issue of affordable housing is going to be on demand, with suppressed income as it is. Now, when you say affordable housing, from where you sit with your research, where are these affordable housing units currently? how they spread out?
So currently, affordable housing is still quite a huge challenge. We've been expecting the government to deliver its promise of 500,000 units, and they haven't. They're not even near the target. I think as of now, they've only built about just a few hundreds, I think 200, 300 at most units. So the onus is definitely on the private sector to come in and do whatever the government is not doing. So the issue for developers is usually, the main challenge is usually land cost. And within Nairobi County, the land costs are quite high. So for the private sector to come in and fill in this gap, they have to definitely go where land is affordable to allow them to build affordable homes. So where land is affordable is definitely in the satellite towns, areas like Kuriru, areas like Ruaka, areas like Ngong, at the river. So those places we have infrastructure, and we have affordable land, and we have land in huge supply. So the other challenge with Nairobi County is that development land is quite in short supply, and that also plays a factor in why the land prices are so high. So in those areas we have affordable land, and definitely the land is in bulk supply, so you can get huge parcels of land. And that's why we've been seeing actually a lot of master planned communities, areas that are built, projects that are built on hundreds or thousands of acres. So yeah, that's where we expect developers to
look at. There's also been this question: how affordable is affordable? From where you sit, let's look at for example, someone who takes home currently 30,000 shillings. What would be affordable in terms of affordable housing for him or her?
Yeah, so affordable is definitely a relative term. So for everyone, affordable is different. So for a person who's earning 30,000, we usually go by some UN recommendation. So according to the UN, you're not supposed to spend, or rather you're supposed to spend about 30% of your income, not more. You can spend less, but not more, on rent. So if you're earning 30,000, assuming that is net, 30% of that, it means you're supposed to spend about 9,000 per month on rent. So the issue is now when that comes to buying a home, it's rather not possible, because you are supposed to, most people depend on mortgages or loans, so you cannot service the mortgage with 9,000 shillings per month. So I think that's why a lot of people opt for renting, because you can get a rental for 9,000 shillings. But now to get a good rental, you definitely know that's why people now go for areas that are way further from the CBD, but they're able to get a good house or a decent house for that kind of money. So the thing is, people now they forgo the long commutes for a good house. Yeah.
Now you've talked about mortgages. The way things look, are we expecting, a suppressed uptick of mortgages, brought about by the issue of COVID-19?
Yeah, definitely. Mortgages have been an issue in Kenya for quite a long time, because in our country, not a lot of people earn enough income to be able to service the mortgage, or to even be able to take a mortgage from a lending institution. So according to data from the KNBS, I think about 2.9% of Kenyans earn more than 100,000 shillings. So majority earn below, about 75% earn below 50,000 shillings. So with 50,000 shillings, it's also quite impossible to service a mortgage or to get a mortgage in this country. And now with COVID-19, now even that is going to be even worse, because a lot of people have lost their jobs. A lot of people, other people have gotten salary cuts. So when if there was a mortgage challenge before, right now it's going to be even worse. That's what we expect. But then there's also the aspect of the Kenya Mortgage Refinancing Company. So it's this institution that was started by the government and the World Bank to make mortgages more affordable. So by making mortgages more affordable is by providing long-term mortgages, probably up to 20-25 years, and at lower interest rates. So the issue with the mortgage market, what we've been seeing currently without the institution, is that we have high interest rates, and the mortgage periods are very, very low.
Yeah.
So on average, it's usually like 5 to 12 years. So that makes monthly payments way high. So with this institution, if they make mortgage periods longer, the monthly payments will be much lower, and a lot of people will be able to afford or take mortgages. But the thing is, the institution is taking a long time to become operational. It started in 2018, I believe, and up to now it hasn't. But I believe they did announce some time back, I think 2 weeks ago, that they are ready to commence operations. But they haven't released official communication. But with the institution, we definitely now expect mortgages will be more affordable, or they'll help to make the impact of COVID-19 way less on the market. Yeah.
Now, this is a question from a developer point of view. If I was liquid enough, and I wanted to, I'm in the real estate and I'm eyeing to just invest, what would you recommend? Would I go for affordable housing, or what you call social housing, and where would I be investing? And just in terms of returns, would they be short term, long term?
Yeah.
Where would you advise a developer to actually invest in right now?
So as an investor, it definitely you have to consider a lot of factors, but generally in real estate, it's a long-term goal. That's the best. That's why you reap the biggest returns. So with especially like residential, so you can go for low-cost housing where majority of demand is going to be, because a lot of Kenyans now are going to be actually low-income earners. So definitely there is demand for affordable housing. However, even in the upper markets, there's still pockets of value. So areas like Westlands, areas like Kilimani, you get good rental yields of even up to 7%. So it just requires you to do your research and to identify that niche properties where you can get rental yields. So even those markets that are overheating, you can get a good deal that guarantees you good returns based on whether you want rental yield or capital appreciation. Yes, you can definitely get those pockets of value. In the commercial office sector, as I mentioned before, some areas, most nodes are experiencing an oversupply, but there are those areas that have good demand, especially from multinational firms and big corporate firms in Kenya, areas like Karen, areas like Giri, where the supply is not as high. So I wouldn't advise you to go to areas like Upper Hill or CBD, because there's already so many office buildings. So you have to look at those areas where the supply is not as much. For retail sector, Nairobi, we are seeing a huge oversupply, so the demand is not as high. The supply is way more than demand. So for retail sector, we advise either you are investing in mixed-use development, because actually mixed-use development now is going to be another trend that is going to catch on quite quick. People right now are seeing what with COVID-19, you want to live in a place, or even with another pandemic, we don't know if there's ever going to be any other. So we definitely do see people want to live in a place where you can live, you can work, you can shop, in just without having to go outside your compound. So that's where mixed-use developments come in, and retail developments are big on that. So if you look at development like Two Rivers or Garden City, where you can live, you can work, you can shop, you can do so many activities, recreational activities. So such properties are going to be in huge demand within the retail sector, and definitely now in those counties where the GDP per capita is quite high, so people have high spending power, and yet the mall space is not as much. The hospitality sector, with tourism being affected.
Now, before we talk about the hospitality industry, we've seen uptake of furnished apartments, on the rise. Why do you think this is coming up, especially when you're talking about residential?
The furnished apartments are actually a trend that has grown quite high over the past couple of years, and the thing is, there's this demand for short stay luxury apartments. Hotels are tend to be, if you look at the daily charges for hotels, it's quite high, but now if you think you can get a well-furnished apartment which serves, it's like a home away from home, so you get to be in a whole new environment that is already furnished for you, and you don't have to go to a hotel. Then for people who just want to go for vacation in a different location without having to pay for so much in a hotel, then that's why we're seeing a lot of demand for furnished apartments. The other factor is that with foreigners coming into the country, and maybe you're coming for 1 month, 2 months, you don't have to go stay at a hotel, which at the end of the day you're going to be paying for so much. Well, you can stay in a good location like Kilimani or Westlands in a furnished apartment. Yeah.
Now that brings us now to the hospitality industry. You've said from where you sit, this has been one of the worst hit areas, or other sectors by COVID-19.
Yeah.
We've seen a trend with hotels, especially repurposing their spaces. In that now, other than just offering meals, they're also repurposing their spaces to offer a conducive place to actually work from.
Yeah.
Is this a trend you see catching on for the long term for the hospitality industry?
Not really, because the hospitality sector, the issue is that it's quite reliant on tourism, and by tourism, most of the tourism comes from outside. So now with that not happening at all, hotels within, they have to change their business models to at least survive during the pandemic. But definitely once tourism is back on track, we expect hospitality sector is actually going to be one of the sectors that will recover quite quickly, because we expect now, with people having been locked up for quite a long time, the travel bug will be quite high, so there's going to be a lot of travels, and we definitely expect the hotel sector to recover as quickly as the pandemic is over. But for now, they definitely have to support themselves through the pandemic, so that's why we're seeing them repurposing their facilities and trying to survive through the pandemic. Yeah.
Now, from where you sit, Wacu, the performance of the sector, for the first 6 months, January to June, how does it compare with last year? A time like this, January to June, how did it compare?
For the various sectors, the one sector that was affected, as I said, was hospitality and retail. So compared to in the first half of 2020 compared to the first half of last year, for instance, rent yields this year, they came in at about 7.4%, and last year they were at about 8%. Occupancy rates, they also declined by quite a lot. I think they were averaging at about 75-76%, and this year they're about 70 or to 74%. So the decline in occupancy rates has been quite notable. Same case for the office sector, with businesses closing down, no more uptake for the available office spaces. So occupancy rates and rent yields have also gone down by quite a huge percentage. But the one sector that has remained resilient is residential sector. So occupancy has remained relatively the same, and also we did see, compared to last year, the price per square meter or the unit prices for homes did actually increase this year. So when you look at the price per square meter as of 2019 in June versus June as of this year, the price per square meter has gone high. What has happened is that the difference between the notable difference has been between March and June. So with the COVID-19, we did see we have seen a lot of not really a lot, but some people trying to sell residential properties as distressed properties. So between March and June, we saw that's where we saw the decline in prices. But compared to last year, prices remained either relatively the same or they increased marginally. Yeah. Now,
just speaking away, just without just looking at Nairobi, let's talk about counties neighboring Nairobi.
Yeah.
We have Kiambu, we have Machakos, we have Kajiado. These counties that are around Nairobi. How has it been in as far as the real estate sector? What are our expectations going forward?
So for areas around Nairobi, those are satellite towns, we are seeing a lot of focus or developers launching affordable projects. So that's the one thing that is happening for satellite towns, low-cost homes and site and service schemes, because the middle class is now shifting away from Nairobi to those towns because it's more affordable to live there overall. So a lot of people are, even though you work in Nairobi, they're choosing to go live in areas like Athi River, areas like like Thika, Ruiru, Ruaka, where housing is affordable, but overall, if you put together the transport or the commuting cost plus the living cost, is quite affordable for you compared to living in Nairobi. So we do expect that to continue because those are the areas that are exhibiting a lot of demand, especially for low cost. So as I mentioned before, there are factors that are supporting those areas. Availability of infrastructure. The government has been continuing to improve infrastructure in those areas. Case in point, in Ruaka, there is the construction of the Western Bypass ongoing. There's the expansion of the Northern Bypass already. They launched water and sewage projects just recently. So there's a lot of going on. There's a lot of activities going on for satellite towns that are going to be able to support developer activities. And for developers, we definitely see them focusing more on affordable housing.
Now, with this demand within those satellite towns, then are you seeing a situation where rental prices are likely to go up because of increased demand in these areas?
Yes, definitely. With demand means more growth in prices and rents. So yes, definitely that's going to be a factor, because unless now the demand was low, that's when now prices and rents come down. But as long as demand continues to grow, then rents and prices are also going to continue growing, and that's a good thing for investors and developers, and that's why they should look at such areas for investment.
Now, as we come to a close, from where you sit, what are your projections for the next half? The next half of 2020. What do you see in the next? What do you see in the next 6 months?
Well, it's quite hard to tell, especially with COVID-19. Experts are projecting that the pandemic will be over by Q4 this year. Some are saying 2021. The farthest I've seen is 2022. But the real estate sector is generally going to go hand in hand with however the economy will be performing. So our projection is that, especially right now, already the economy has started to reopen. So with the economy reopening, people will start spending more. And one thing that has affected the real estate sector and any other sector is a reduction in consumer spending. So as the economy reopens and regains its momentum and people start spending again, then we definitely do expect the real estate sector to recover. Right now, we remain neutral. We're not too positive or too negative. We just remain neutral because we do expect things to get better. Already they're getting better with the economy reopening. So demand for investors, they definitely have to undertake their research and just see where demand is. With areas like, with sectors like the retail sector, we expect already e-commerce shopping has taken hold, or it's growing quite fast. So for retail sector, we definitely expect growth in e-commerce. And e-commerce, on the other hand, supports the industrial sector. So we do expect to see demand for more industrial space, modern logistic hubs, so that's going to grow. For the office sector and the residential sector, we expect for both to recover within the next 6 months, or even the farthest it can go to, it's probably next year as the economy activities come back. But we do expect developers also to take advantage of the fact that digital tools are going to help them in their businesses while the pandemic is still ongoing. So they have to now change their business models, because that's the one thing that is proving to be helpful during these times, being digital and making use of technology and any other innovations.
So, Wacu, real estate is still a place to invest in long term, COVID-19 or not? Okay. Not just for Kenya, right? Also regionally.
Actually, there's a poll that was done recently by an international research firm called Gallup, and investors. It was actually done last week, or released last week rather. Investors show 35% chose real estate as their number one investment, and then the rest, 20% were they said things like gold, the stock market. So yes, investors globally still choose real estate as their number one investment, and it's a long-term. The good thing with real estate is that it's a long-term goal. So while COVID-19 is probably short-term or medium-term, so real estate is going to definitely outperform the impact of COVID-19 on investments.
Very well said. That has been our guest this morning, Wacu Mbugua, research analyst at Cytonn Real Estate. And just to borrow a few tidbits from her, is that indeed the real estate will outperform COVID-19. So if you are eyeing a long-term investment, well, then you need to look at the real estate sector, especially, affordable housing, and expected that there's going to be a lot of demand for affordable housing with the current, economic status, as well as we expect going into the future that residentials are going to take a different turn, and accommodate that study, that office space. Right now with, Kenyans having already experienced that, you can work from home. So we're going to see, developers focus on that. And in regard to office spaces, well, there's a glut within Nairobi, but there's also demand in areas like, Karen and Gigiri, where there's a demand. So that's a place you need to focus on if you're keen on investing in the real estate and looking at, in matters of office space as it is. Now for retail, there's a glut within the CBD, but there's also demand. There's also demand in, satellite towns and counties like Machakos and the likes. So that has been the take home from this conversation in regard to the real estate. Taking home there from our guest there, who is Wacu Mbugua, saying she is confident that the real estate sector will outlive COVID-19. So if you're looking for a place to invest long-term, the real estate sector is still a viable option. I've been your host, Regina Manyara. See you tomorrow, same time, for conversations that make sense to you and I. Have a great day ahead.